Hello and welcome. Today we're diving into the Indian equity markets in 2025 with Ashutosh Bhargava. He's fund manager and head of equity research at Nippon India Mutual Fund. With mid and small caps still struggling and markets swinging, you're probably wondering, are we past the worst or is more turbulence ahead? So stay tuned as Ashutosh breaks down where the opportunities lie, how he picks winning stocks, and what sectors could shine this year. So let's get started. Welcome, Ashutosh.
Hi, thanks for having me.
Great to have you back with us. Ashutosh, how would you describe the Indian equity markets in 2025? Like, what are the primary drivers of its performance right now?
Yeah, so as you all of us are aware, this year has been extremely volatile. The start of the year, we didn't see so many different kind of news flow affecting the market. But if you observe the market now on a YTD basis, year till date basis, markets are actually higher and climbing the wall of worry. Uh, so the whole decline from September till March, in my opinion, was mainly due to the sharp disappointment in earnings. And what perhaps market is anticipating now is that worst of earning downgrades are behind us. And this earning season itself, which is just concluding January to March earning season, the breadth of earnings have come in much better than what people expected. And in most sectors and companies, earnings have actually surprised on the positive side. Um, there has been enough cuts for earnings for FY26 and FY27, and with meaningful improvement in local monetary conditions, with the very supportive RBI, there has been improvement in terms of uh, fiscal stance of the government. So the whole domestic policy environment is turning favorable, and the hurdle rate for the market over the next 12 months has, in terms of earnings, has become much easier. Market being forward looking is now realizing that the worst of the news flow, worst of the earnings is behind, and therefore it's actually now started to look much better versus where we were 3 months ago.
So, should investors prepare for more ups and downs, or is the worst behind us right now?
In my opinion, the worst is behind
Okay.
because market mainly cares about earnings, and worst for the earnings are behind. Even in terms of the news flow around tariffs, etc., I think we are well past the worst of the news flow. There as well, there has been some improvement. So, in my opinion, from here on, while some of the recovery from March has already happened, but the worst of the market is behind, and the investor should look to increase allocation if at all there is more, interim downside.
So actually, those markets are such that we don't know what's going to happen in the next few months or few weeks, kind of thing. So, what kind of risk do you anticipate coming in the market, and how should investors navigate those risk challenges?
So one of the things we are all aware is the Indian geopolitical situation. If anything, while it looks settled now, but if there is more news flow around that, that could be one potential risk. Other risk is obviously related to some accident in the global fixed income market, particularly US or Japan, where the central banks are not supporting the market as much as markets like India, where central bank has been extremely supportive. Uh, Beyond that, I don't think there are many risks now. Yes, the news flow will continue. We can't escape the news flow in the current global political environment, but I think market may continue to climb wall of worry. From investor perspective, uh, our advice always remains the same: be disciplined. If you are into SIPs, continue with that. And for whatever reason, if market corrects by 5-10%, I would actually recommend to increase equity allocation with the mindset of 2 to 3 years, because as I mentioned, worst seems to be behind us.
Okay, so how do you see the valuation differences between large, mid, and small caps right now, and which segment do you think offers the best balance of risk and reward?
So very interesting one actually. If you look at large cap versus mid and small cap, there is one pocket which is large cap, which offers relatively better valuation comfort. But when we look at earnings from now till next 2 3 years, small and mid caps offer much higher and better earnings growth profile. So I would rather suggest that that the risk reward, we should not be looking from size category perspective. As a combination of these three categories, uh, funds like flexi cap and multi cap funds, where the fund manager has opportunity to look beyond the size, restrictions across market sizes, across various sectors. I think there are enough risk reward. Lastly, I think this debate of large, mid, and small, to me, it is not very relevant in today's context and even in the future context. Because at the end of the day, the profit pools are very different. The profit pools that small and mid cap offer, there are many emerging high quality, high growth profit pool which are absent from the large caps. So optically, large caps may give relative comfort of valuation, but then, as you rightly use the word risk and reward and price value gaps, I think if you're looking for both right price and right value, then this whole large, mid, and small cap debate should be kept aside, in my personal opinion.
Ashutosh, you're making a very interesting point that in the next 3 to 5 periods, even though the valuations of small and mid caps are a little bit on the higher side, they
That's
offer
true.
they offer terrific growth potential compared to the large cap.
Right.
Okay, okay.
If you just think of a large cap index, there are many sectors like FMCG, IT services, some of the very large banks, which may not offer earnings growth which is higher than the market, not only in the next 1 year, we are talking about next 3 to 5 years. And this would comprise, say, 50% of the whole market. In that context, I think the growth rate for the broader market may continue to outpace the large cap space.
Okay. Ashutosh, now coming to your personal investment style and personal investment strategy. So, what's your investment strategy, and how do you select the stocks for the portfolio, given the dynamic of the markets in the current scenario?
I'm more of an evidence-based person. I believe less in forecasting and more in assessment. Uh, I rely significantly on our research team. We have a very large research team. And my motto is that, instead of top down, bottom up is the right approach in the sense that it's more repeatable in nature. Taking the macro calls is becoming difficult day by day. What I prefer in general, and as a house also we prefer, is to look at, not get fixated with growth versus value kind of debate, but rather look at areas and sectors where the growth rates are superior, and then look for valuation. So it may be cliched, but GARP is something which is what my style or my team style would be. And in that context, other than the macro, we are also very particular about the competitive intensity of different sector, because right competitive environment would only provide pricing power to the companies. So macro is important, but micro is more important for me and at Nippon as a team as well.
Right. Now, moving on to a few fund-specific questions. So, Nippon India Multi-Cap Fund, it had a great run. It outperformed significantly from 21 to 24. It was among the best performing funds since the launch of the category and delivered significant alpha over the benchmark also. So, what drove that strong performance, if you can elaborate on that?
Yeah, so there are only two sources of alpha. One is the selection effect, other one is the allocation effect.
Hmm.
Selection effect is you choose the right stock in every sector, and allocation is choosing the right themes and the right sector. In this particular fund, both the things have worked in our favor. The allocation effect has particularly worked for two categories where we took sizable deviation from the benchmark, and it worked in our favor, which is industrials and consumer discretionary as a sector. So across the board, we were overweight on that theme. We were more positive on domestic demand, and within the consumption as a segment, we were overweight on discretionary and we were underweight on staples or mass consumption related segments. That has worked in our favor. In a lot of other sectors where I see, the like financials or even automobiles, the stock selection helped more than the meaningful deviation versus the benchmark. So we could identify better risk reward within the sector. So it is the combination of both, two to three sectors where we took sizable deviation from the benchmark, and then our repeatable, superior internal research, which helped us identify right stocks in each of these sectors.
Right, but it's in third quartile this year. So, what has caused this dip, and are you doing anything to bounce back? What is it?
I don't think we are doing anything different. The philosophy remains the same.
Yeah.
Try to identify right businesses from medium term perspective where there is, improving visibility of earnings and the valuations are not adverse. These are the same things which we are doing. In our opinion, the difference versus us and others are not significant. And any which ways, we are not perturbed about shorter term inline performance versus the peer group. So we are not doing anything different and we are extremely comfortable with current positioning of our portfolio.
Ashutosh, another interesting aspect which we saw about this fund was that, it's a typical buy and hold strategy, which you hold the stocks for the long period of time, but you also actively add newer stocks into the portfolio. So the fund holds around 120 stocks, but nearly, 70, 75%, 74% of the portfolio is concentrated on top 50 holdings. So what's the reason for it?
See, we need to have higher number of stocks because in this fund, we are not running one size category. There are three different funds, if you may like, we are managing here. We need to have minimum 25% in each of the size category, large cap, mid cap, and small cap. So if you are constructing a large fund, in each of these category, you need 30, 40 stocks each, right? Within that, the bias always remain that if there are stocks and themes where the conviction level is high, there we don't take, marginal bets. We take sizable bets. There is a defined overweight that we create, and then we stick to it unless there is a meaningful deviation from our initial thesis. And that is a reason where if you look at our active share, which remains high versus the benchmark, but at the same time, churn is very reasonable considering that every 6 months there are SEBI related benchmark changes where we are supposed to do these size category related churn, but despite that, our churn is extremely limited. So the medium to long term mindset in all these size category is something that we follow, and therefore you will find a large part of the portfolio remains consistent over the medium term.
Coming to the hybrid categories, among the hybrid funds, at Value Research, we are more comfortable with the aggressive hybrid given the more defined asset allocation pattern. So, as an investor, has a very definite cue about where fund lies in terms of their asset allocation, like equity and debt. So, just wanted to understand what kind of investors do you target with the kind of strategy in the balance advantage fund?
In balance advantage fund, obviously, the idea is that we can go down in terms of net equity allocation, depending upon certain factors like valuation and evolving global and local macro situation. So we typically move between 30 to 80% in terms of net equity. And whenever we have to come below 65% gross equity level to bring the net equity down, and time to time, because of higher valuation, other factors, we need to provide those hedges. We opt for, hedge this portion with the help of stock derivatives. Now, the idea here is that this is suitable for those investors who are looking for lesser stress uh, in equity investing, because even a normal hybrid equity hybrid fund would have higher volatility vis-a-vis the asset allocation fund like BAF. And there, the whole idea is that return should be looked from the lens of return per unit of stress taken by the end investor. So that I think is very comfortable here. And in this particular fund, we focus more on the large cap space. 80% plus of the gross equity portion is in large cap. So typically the focus is more towards safety, lesser variability. At the same time, try to be more consistent, be in quartile to as much as possible across shorter, medium, or longer time frames. So this is what we do, and is very suitable for people who are looking for return with lesser risk, lesser volatility, and lesser stress.
Ashutosh, if you could help us with your view with the investment case for the multi-asset funds.
In a multi-asset fund, we have two such options. One is static asset allocation fund, where we provide very good diversification to four different asset classes: domestic equity, international equity, commodities led by gold, and the residual portion goes into high quality fixed income. So this is a fund which is suitable for people who are looking for proper diversification, where domestic equity, while around 50%, is not 65, 70, 80%, which is there in some of the equity hybrid categories. So equity portion is limited. 50% of non-equity portion is in categories which provide right diversification. And it's very simple. It's for those people who don't like black box, who don't like dynamism, and they know what they are getting. And from our end, we try to generate alpha with the active fund management that we are doing on domestic equity side, commodity side, as well as on the fixed income side. So it's just very simple product, has been very effective. And the last thing is that in this particular product, the taxation is 12.5%. If someone stays there for 2 years or more, the LTCG benefit is similar in terms of 12.5%, which is akin to equity fund. The other category of multi-asset allocation fund that Nippon has, again, a very successful strategy, is Nippon Active Asset Allocator Fund of Funds. There, rather than investing in equity actively or different asset class actively, we invest in our own funds. Again, in this particular fund, there is a model behind it. It's a multidisciplinary approach. We combine with 7 to 8 variables, and it tries to help us in 3 different problems: which asset class to choose, which sub-asset class to choose. So, for example, you have chosen equity. Within equity, the next question comes, in which you already asked me, whether we should invest in large cap, mid cap, small cap. And those are the questions which this category, this particular fund try to answer. So it invests in three equity funds: large cap, mid cap, small cap, and gilt fund and short-term debt fund. And this last fund is the gold fund. So between 35 to 100%, it can be in equity. Between 0 to 65%, it can be in fixed income. And up to 25%, it can be in gold. Over the last 4 years or so, since the inception of this fund has done a very good job in terms of absolute and risk-adjusted return. Again, this is suitable for those investors who are open to look at model-based asset allocation rather than static allocation.
So while you have touched upon it, can you please elaborate on the investment framework followed for these portfolios, since these are the kind of funds that every AMC run them differently. So if you could just elaborate a bit on that.
See, the choices are generally two. To what extent you want to diversify?
Yeah.
2 asset classes, 3, 4, how many? And the second is, do you want to bring more complexity, which gives you some potential to create extra alpha, or you want to do it in more static manner? So as I said, at Nippon, at least we have both the offerings. So the whole idea here is that in terms of choice that investor has, they can choose either of them, static allocation or dynamic allocation. The framework which goes behind the dynamic part, the models that we run for BAF and these kind of funds, we don't solely rely on valuation alone as a concept, or we don't forecast anything. There are variables like dollar, commodities, price momentum, market breadth. Other than valuations, we look at these factors and we try to have very diversified approach in terms of input variables. So 7 to 8 variables, which help us diversify, the signals that we are getting. And this help us navigate between different asset classes, different sub-asset classes. And most importantly, they help us avoid the drawdowns. And this has come very handy in the last 12 months. And in my opinion, where markets stand today, if people have still not considered looking at the portfolio from asset allocation lens, because what has happened in the last 4 5 years, inadvertently equity portion in everyone asset allocation has gone up. The market has done well and people have invested more. So I think it's a good time to look at these funds where return expectation has become more moderate, and both equity and fixed income can give you upside, which is similar, because even fixed income can has been doing very well, and there are more scope for interest rates to come down. Taxation is same. The only difference between multi-asset allocation funds versus say balance advantage fund is that 12.5% is same. In balance advantage fund, you can avail it in 1 year, and for availing the 12.5% LTCG benefit in multi-asset allocation fund, you will have to wait for 2 years.
Now, Ashutosh, for retail investors, worried about the sudden market drops, what practical steps can they take within their asset allocation to reduce the risk without missing the upside or potential gains?
I think the most important thing is focus on asset allocation, as I mentioned, but don't do it yourself, because the taxation is very different. If you do it yourself versus you come in these multi-asset allocation fund, where you can have only 35% equity, 65% could be in even fixed income. In India, the problem is that anything which comes with the word income, dividend income, rental income, salary income, fixed income, it attracts marginal taxes, right? Which could be as high as 39%. So if you want to avail, the benefit of right taxation with right diversification, with right kind of safety, the best approach is to go with these multi-asset allocation fund and have the mindset to stay there for 2, 3, 4, 5 years. Make it a nucleus of your portfolio. If you're solely an equity investor, my suggestion always remains that look, where the risk can hit us, there could be many known and unknown factors. We have all learned in the last 4 5 years, right? So in that context, systematic investing rather than lump sum at this point of time, I would recommend keep doing it unless you think market for whatever reason comes down by 10, 15%. That's where you should think for lump sum. Otherwise, all your lump sum money should go into these asset allocation fund for better risk adjusted return.
Right. Now, moving on to momentum funds. So, managing momentum funds can be tricky. So, how do you spot stocks with lasting momentum, especially in volatile markets?
See, momentum as a strategy is, in my opinion, is looked down upon because it looks like there is a lot of randomness in picking stocks. But if you look in more closely and look at the evidence which is available, typically momentum happens in those stocks which are where there is an earnings momentum. Market is very, very rational. When we think of price momentum, it's a wisdom of the overall market and various participants. Typically, when we look at momentum fund, we look at both the momentum, the buy side momentum and the sell side momentum. Buy side momentum is through price momentum, which is, you look at which kind of stocks have outperformed the market over the last 2 to 4 quarters. And in terms of earnings momentum, we look at where the sell side, the so many experts across different notable brokerage houses, what are they doing in terms of the earning forecast or target price changes? And we take that into considerations. So for us, combining both the buy side and sell side wisdom perhaps works better. So when we say momentum, we are looking at both price and earnings momentum, and irrespective of the market, in my opinion, this strategy can produce pretty decent results.
So, Ashutosh, what are the biggest challenges when the market currents or there is a trend in the reversal in the trend, and how do you handle them in the momentum funds?
This is actually a very, very good question. You should also know when not to do momentum investing. Momentum investing can be very nasty and painful at the sudden turn of a cycle. Suppose you are in a bear market and suddenly some good news comes. The rotation will happen in those stocks where there was no prior momentum. Similarly, if like last year, September, August, September, the winners till that point of time, over the next 6 to 8 months, they were the biggest losers, both in terms of size category as well as in terms of sectors. What is important is to identify periods where you identify lot of extremities. So there are couple of indicators that we follow where we identify this is not the right time to do momentum investing. I'll give you one example. There is there are stocks, which are there in the market. Every stock would be above its 200 DMA or below 200 DMA. So we look at the breadth of the market. Say, for example, 90% of the stocks are above 200 DMA. That's where there could be more comfort, but there is a lot of risk. That market is already run up. If for whatever reason it turns, momentum investors can suffer a lot. Just couple of months ago, number of stocks above 200 DMA were less than 10%. Right? At that point of time, the idea was to get into the stock which have more beta and take more equity risk, get into those kind of segments. So when not to do momentum can only come handy when you have framework for identifying these extremities. In the interim, 80-85% of the time, momentum investing can give you superior return. As long as you can avoid these sharp turns and you have a system around it, momentum investing can be extremely beneficial.
How do your quant funds stand out from other quantitative strategies, and what unique methodologies or data driven approaches do you employ?
It has done very well versus a lot of other quant funds, both in terms of absolute return, but more importantly, in terms of risk-adjusted return. So the way we run our quant fund is more of a large cap focused strategy where number of stocks are limited to 35, and roughly 80% or above exposure is into larger companies, large caps. So it is in that sense large cap focused kind of strategy. What we do is that we don't buy any stock which is not a part of BSE 200 or NSE 200. So we never go out of the index. Second thing is that the whole equation or the strategy is not relying on one factor. So it's a combination of valuations, growth, quality, the delta around growth and quality, and also some of the behavioral and technical factors like price momentum and sell side sentiment. So it's a multidisciplinary, very very diversified, explanatory model, which helps us identify stocks where the earning outlook is improving and they are available at the right valuations. This has worked across timeframes well for us, and we think that not fixated to one particular style has helped us.
Ashutosh, you mentioned earlier on the mid cap and the small cap thing, but they have dropped nearly 18% since September. And you stated that the recovery is there in this segment. So are there any other factors which you are looking for the turnaround in these segments apart from this earnings?
So mainly it is about that. So if you look at small and mid cap as a segment, they are more domestic oriented segments. What is happening in domestic economy, as we discussed, that government has provided tax relief to the middle class. RBI is easing both interest rate and liquidity conditions. There is an expectation of good monsoon. Inflation has come down. EMI rates are coming down. Government spending in general has picked up versus 6 months ago. And more importantly, as we go into next year, there is an expectation for pay commission as well. A lot of these companies in this segment would benefit when, in the second half, perhaps, when with some lag, this interest rate cut and the tax cut would start to benefit as we enter the festive season. Many segment, particularly domestic demand-oriented segment, would benefit. Market being forward-looking, market is expecting more than 30% earnings growth for the small cap over the next 12 months and around 20% earnings for mid cap. This is much higher than 13-14% earning, which is expected in, say, for example, Nifty large cap, right? So clearly, earning, in my opinion, is the clear answer. There has been meaningful cut in earnings in the broader market, and that is the reason why they underperform. And now with earnings being much superior than the large caps, even with the higher valuations, this broader market, which is mid and small cap, that has stopped underperforming the large cap in the last 2 months.
So, when picking mid and small cap stocks today in these market conditions, what qualities do you prioritize? Balance sheet strength, governance, growth potential. What is it that you prioritize?
Some of the principles and tenets are same across size categories, that you are looking for right sectors where the TAM is large, addressable market is large. You're looking for right competitive intensity, should not be too high. Like what we are seeing in FMCG in other areas, the competitive intensity is very high. Those factors aside, in small and mid cap, there are a couple of factors which comes to my mind are very important. One you already mentioned, capital allocation, balance sheet. Time and again, the big risks come if companies make mistakes knowingly, unknowingly on the capital allocation side. So we are very cognizant of that risk. And in small and mid caps, governance, risk, and particular management quality, both in terms of risk of not doing anything bad, but also equally importantly, these management, they should have vision, and they should have the uh, ability, intent to take the business to the next level. So managerial competence as well as governance becomes slightly more important in terms of checklist when it comes to small mid caps versus large cap, where the organization and the size of businesses that itself take care of a lot of these issues.
Okay. So, Ashutosh, before we wrap up this chat, the last one, which are the sectors do you think are more promising in 2025, and what makes them attractive from a fundamental or a growth perspective?
Two things that we like as a house level, and you will find almost all of our funds we are overweight. One is on the in capex side, investment side, which is the power theme. We think there is a very meaningful demand supply mismatch of power, and not only locally, it's a global theme with the use cases increasing in the form of electric vehicle, generative AI, etc. With new, the alternative sources of power coming in, you don't, you not only need more power from different sources, but you also need a much better and bigger transmission and distribution infrastructure. So this whole value chain of utilities, transmission companies, there are select equipment providers, select financiers who are geared toward this sector. We are positive on all of it. So we think this has a very good shelf life. It's some of the emerging themes like Gen AI, EV, etc. You can play through power sector. The other theme which we like is the consumption on the discretionary side. As I mentioned, Indian consumption has become very geared towards the monetary policy because the leverage for consumption consumers have gone up. With the kind of favorable RBI we have, the kind of interest rate decline that we are seeing now, it will result in much lower EMIs, and maybe in couple of quarters time, better credit growth, particularly in the unsecured lending side where there has been some slowdown. So we think consumption discretionary as a sector will continue to do well. So versus mass consumption, we like this. And again, the premiumization is a medium-term theme. With the pay commission, which is in next 12 months, up to 5 lakh crore of extra income would come to the government employees, both at center and at the state level. And historically, whenever this has happened, it has led to better growth in areas like passenger vehicles, travel tourism, retail, etc. So these are the categories we think have been doing well and may continue to do well.
Well, thank you, Ashutosh. Thank you for joining in today.
Thanks for having me.
And if you found Ashutosh Bhargava's insights helpful, don't forget to like, share, and subscribe for more expert interviews. Stay invested, stay informed.